Well, good afternoon, everyone. Welcome to The Brew. My name is Jennifer Nadeau, case designer here with E4 Insurance Services. And for those of you joining The Brew for the first time, we like to kick off the Brewcast by celebrating what national day it is today. And as usual, there's a great list of them. It is National Pennsylvania Day. It is also National Lollipop and Hot Dog Day. I'm not sure if those two go together. And I'd like to give a call out to the national day it was a few days ago. Right before the Brewcast, I was informed that July 18th was National Insurance Nerd Day. So I think we're gonna geek out a little bit today with Geoff Murtha. Geoff is managing director at MassMutual, and he is joining us today to talk about the myths and misconceptions of whole life insurance. But before we get started with Geoff, I would just like to remind everyone that we will be doing a drawing at the end of the call for a prize. And as we go through the presentation today, please remember that you can use your chat box to ask any questions. But Geoff, I would like to welcome you to the call at this time. Thanks so much for joining us.
Yeah, thank you. And I apologize. I'm having a little bit of technical difficulties. So I'm on one phone, and I think I just got my camera up. So Jennifer, if you look and make sure that I'm up on the screen.
Okay, so let's get started. Geoff, when we were talking, we had discussed how whole life insurance is one of the oldest forms of life insurance out there. With that, there's a lot of guarantees associated with it, a lot of safety associated with it. But one of the myths that you will dispel for us today is that whole life is a very expensive solution for our clients. So can you speak to that a little bit today about the cost of whole life insurance and how expensive really is it as it relates to that?
Yeah, absolutely. Well, Jennifer, thank you for the question. And thanks everyone for having me on the call today. I apologize for the technical difficulties, having a little trouble with the Wi-Fi here. Well, to answer your question, I think, yes and no. I think if you're looking at us for a pure protection type of product, we are going to be a little bit more expensive, and that's by design. When you look at GUL or you look at GVUL, that's really priced for death benefit only. When it comes to whole life insurance or survivorship whole life insurance, not only do we have that guaranteed death benefit, we have the guaranteed cash value element that we can't just decouple. We can't pull that apart. So you're always going to be paying with that premium for that guaranteed cash value. Now, there's some things that we can do with some term blend riders to make that a little bit less expensive for a little bit more premium tolerance for the customer. So on the protection side, there really needs to be some sort of secondary or tertiary objective where cash value makes sense, whether it's inside of a trust and you need it for gifting and flexible premium down the road, or it's just having that common sense cash cushion and having that reliable, durable, guaranteed cash value with the dividend to help for any kind of future needs. I mean, I'm in my mid-30s, so I think if 20 years down the road, if I want to do something different or just have some kind of equity in my policy, it's going to be helpful to move on to something else or to leave with something as opposed to leaving with nothing. And that's some of the things that you have to consider with GUL, which there's nothing wrong with that. That's just, very, very specific in how you approach those types of strategies. When it comes to accumulation, that's where we're not expensive because we're measuring things a little bit differently there, where it's the whole life's $50,000 premium versus the IUL's $50,000 premium versus the VUL's $50,000 premium, and which one's going to grow cash value the most while assuming the amount of risk that's needed for that customer. And we like to think that whole life insurance does the best job of that because you're taking on the least risk to get some pretty nice cash value accumulations and distributions. So whether you want to call it risk adjusted rate of return or having a higher probability of certainty in meeting those cash value objectives, we think that whole life insurance is going to do the best at that.
Geoff, when you talk about cash value accumulation and whole life, and thanks for addressing accumulation as well, my mind automatically goes to dividends within whole life policies. And what I've heard of some objections when I'm talking about whole life to some of our advisors is that guaranteed dividends are not guaranteed, and they can be too hard to explain. So can you talk about the concern surrounding dividends not being guaranteed and the complexity in explaining them to people that really aren't experts in our environment?
Well, the mutual carriers have done a really good job of hiding how dividends really act and what they're really made of. And I think the first piece of that is warranted. They're not guaranteed, but so is not a lot of things in different types of products, whether it's IUL or VUL. When it comes to dividends, you want to find a reliable company because company does matter. You're actually investing in that mutual company. MassMutual's been around for 171 years. Of the first 17 of those years, we weren't actually a mutual company. We started out as a stock company. And then once the owner of MassMutual was able to get enough capital to buy out the other owners, he then made it a mutual company, of which we paid a dividend every single year since 1869. So I think that's important to have that kind of track record in dividends performance. Right now, we have the highest dividend scale interest rate out there, which doesn't mean everything, but it's certainly something that catches your eye. When it comes to how dividends are actually, how do we come up with that? How do we actually come up with dividends? There's three main components. The first is a mortality expense reimbursement. So in that premium for whole life insurance, we're going to take out the 2017 CSO maximum mortality charges that we can. So if that's up here, well, that's not actually going to be the experience that you're going to get with MassMutual from a claims perspective. So our claims experience is probably going to be somewhere around here. The savings in between from what we actually collect in premium, those savings are going to be shipped back to the long-term policyholders, those participating policyholders, in the form of the dividend. So that's the first component of the dividend. The second is what we call the expense reimbursement. So the expenses you can think of, what does it take to run an insurance company? You have people, you have supplies, you have a bunch of different expenses that go into managing this insurance company from an operational standpoint. We're going to set a pretty liberal level where we think that we can never go above and beyond that. But our actual experience is going to be something better. And again, those savings, we're going to push back to the policyholders. So those are the two kind of expense elements, components of the dividend. The third one, the one that everyone sees and everyone knows, is the investment component. What is that interest rate and how do we drive that interest rate? Well, a lot of times you think that's the general account. And MassMutual came out with a 6% dividend that we declared last year. Well, our general account was somewhere between 4 and 5%. How do you take 4.5% and make that 6? And that's where MassMutual differentiates itself. We have what's called other business earnings. So MassMutual owns hundreds of other companies, which we use those earnings to invest, but also to supplement the dividend. Real world example, last year, our dividend we declared was $1.85 billion. About 600 million of that 1.85 billion is made up of our other business earnings. You can think of companies like Oppenheimer. We sold that for a stake in Invesco. We have Great American Life Insurance Company we just purchased last year, Rothesay, Martello Re. The list goes on and on and on. There's lots of big names in there. And again, we take those earnings and instead of shipping those off to shareholders, we're using those for investment and to supplement the dividend. So it's three major components, and you got to be with a company that has size and scale, especially today.
Yeah, and I definitely heard that loud and clear with your answer surrounding dividends not being guaranteed 100%. I think you said 1869, a dividend's been paid every year. So that's quite the track record. What about explaining that to our clients and what dividends can do for them within a life insurance contract? I think that's another area where advisors that may not be familiar with whole life contracts may feel that there's some complexity there. But dividends, as we know, can do different things within the life insurance contract. Do you have any tips or topics about that as far as explaining what it can do for our customers within the life insurance contract itself?
So, I mean, the dividend can do a number of things. There's a lot of flexibility inside of whole life insurance that you just don't really expect on the surface. And again, I think the mutual carriers have done a bad job of explaining that because we haven't been everywhere. We've been kind of narrowly set to a career age system, which wasn't a bad thing. But now as we kind of expand and grow and meet new customers where they're at, we have to do a better job of explaining what whole life insurance really is. And from a flexibility standpoint, not only can you use the dividend to pay premiums, but you can use it for supplemental retirement income. There's guaranteed cash value of which you can loan against. So you can use the loans or the dividends to help pay premiums. You can do reduced paid up to lower your death benefit as much as possible, but completely stop paying premiums. There's different riders that we can add on to, like I mentioned earlier, a supplemental, what we call LISR, life insurance supplement rider, which will be a term blend that can create some premium tolerance, but also can be a place where you can put a bunch more money. So there's just so many different things from a case design perspective that we can add flexibility and kind of shift the product to feel a little bit more like universal life. But I just say, anytime you make a policy more like universal life, that brings in some of the risks associated when it comes to expenses changing on that side of it. So definitely some flexibility, but you just got to manage expectations.
Yeah, so that was my next question, was surrounding flexibility. And again, I'm going to what I think about, and when I've heard other people say when they think about whole life, and when I think about it, I think, okay, guaranteed premium, guaranteed death benefit, guaranteed cash value, but I've got what I've got. And we all know that our needs change over time, but you did just touch on as far as what dividends can do and the other aspects of the contract. There is indeed flexibility within whole life contracts with the guaranteed safety as well. Do you
Yep.
think that that's safe to say?
Absolutely. And I think that that's a big part of our story right now, especially as there's a bunch of market volatility out there. You have the guaranteed cash value element, which is as sturdy as anything can be out there. And then you have this historically dependable, reliable, durable dividend that you can call upon in times of need. And maybe if you're getting a whole life insurance policy right now and you're going through market volatility, it's not going to save you from a bear market. But if you give it 10 years, 15 years to build, and it's a stable bucket of money that's non-correlated to the market, it's going to be there at the time that you need it. And we have a story, it's called Taming a Bear Market, where when your performing assets start to become non-performing assets, whether that's your stuff in the S&P 500 or the Dow, if it's real estate, if it's your closely held business, if those aren't doing the things you need it to do at the time that you need it to the most, which is getting into retirement, you probably don't want to sell off those assets. So it makes some sense to wait for those underperforming assets to become performing assets. And you need a bucket of money there at that point in time to sustain your lifestyle, especially if you're already in retirement. And that's what whole life can provide, because it's not correlated to those other types of assets. And it's just going to be that common sense cash cushion where you can use it for that. You can use it for college savings. You can use it for everything I think we talked about in the insurance industry for what tax deferred, tax-free types of incomes can provide. It's just on a different part of the risk spectrum.
Excellent. One last myth that I would like to ask you about, and that is surrounding compensation. There's a myth out there that compensation is lower within whole life contracts. Could you speak to that?
Yeah, and I think a lot of times in that, we're not looking past year one. The really cool thing, and especially for financial advisors there who are looking at reoccurring income, is that the dividends, or excuse me, the renewals are very, very healthy in comparison to anything else out there, compared to any of the other products that you might be able to sell. So it's a pretty cool thing to have a sustainable book of whole life insurance because it's going to sustain you beyond just year one. So you can look at the 10-year, because with MassMutual strategic distributors, the renewals are vested for 10 years. So it's pretty cool to look at what type of revenue over that 10-year period versus other products. It's pretty eye-opening.
Okay, excellent. I think we've come to the time now where we can open it up for questions. Again, you can certainly unmute your line to be able to ask a question, or you can also use the chat box. While we're waiting for questions to come in, and I'm just scrolling through here.
Jen, this is Brendan. I have a question. Not really
Yes.
not necessarily a question, but more a comment. I was at a Libra meeting back in May, and they had Bobby Samuelson speaking, who is effectively the guru of insurance right now. And his comment sort of reminded me of what you say, Geoff, and I know that you're paid by the company and you're a wholesaler, so nobody on this line can really trust what you say. But what he said that I liked is as a policy owner in a mutual company, you effectively have an ownership position in that mutual company and their investment portfolio, which is exactly, I think what you said. But I think that's just a great way to look at it. So it's not really a question, but you can comment on it if you want.
No, I like that comment. As you said, I'm not the best messenger to listen to because I obviously get paid. So there's a little bit of a conflict. I get paid to represent this product. But one of the reasons why I wanted to make it back to a mutual carrier, and I've been at stock companies and private companies in the insurance industry, is because of that story. And in my head, it's a flight to quality. It's looking at products that I'm not going to have to apologize for 10, 15, 20 years down the road. And to be with a mutual company where the incentives of the insurance company are in lockstep with the customer, that in my head, there's nothing that beats that.
Thanks, Geoff.
Yep.
Excellent. While we're waiting for other questions to come in, Geoff, let's choose our winner as well. Could you please pick a number between 1 and 39, please?
I got to go with 12, Aaron Rodgers.
Number 12. All right, our winner is Debbie Struthers. Debbie, congratulations. Please be on the lookout for an email from us. You will be receiving a CE voucher and also a Starbucks gift card. So thank you so much. Any other questions?
Yeah, I think, one other thing that didn't really come up in this call, but A++ ratings, 98 Comdex. When you look at the financial strength, you will never, ever be embarrassed with any attorney, trusted advisor for recommending MassMutual based on financial strength. Over $314 billion in assets under management, 98 Comdex. I think that, Geoff, just really speaks. I know when we work with financial institutions, that's extremely important to them when they're holding life insurance assets on their books, and you guys really fit that bill as well.
Absolutely, Dan. I think, like I said earlier, company matters, and those are things that's the reality of the situation. When you're looking at a company like that has that kind of scale, that kind of financial strength, it's going to make a lot of people feel comfortable, and you won't have to be embarrassed about it. You're not going to have to apologize for it.
You have obviously whole life, lifetime pay. You have a pay to 65 type of whole life, but the most popular is really your limited pay, which is the 10. I think you said when you were in the office a few weeks ago that you're coming out with a 12 pay product. Is that accurate? And those? Yeah,
that's accurate. And the 10 pay is definitely our biggest seller. We have direct recognition, we have non-direct recognition, and with the 10 pay, non-direct recognition really sings because we're able to use an adjustable loan rate, which currently is at 4.22%, and using that against our 6% dividend rate, there's some nice arbitrage that works well with the 10 pay. It's a really, really low face amount, high accumulation oriented, income driven kind of sale. And with the market volatility and some of the other struggles, I think, in the environment that we're in, it's that flight to quality. And the 10 pay really hits that tune. The 12 pay that we're going to have come out is going to be a little bit different of an orientation because it's going to be a bit death benefit protection oriented. So you'll be able to put in a lot of money, but you're also, along with the accumulation side, going to have a much higher death benefit than what the 10 pay can afford. So it's two different products, both really good accumulation, but the 12 pay is going to have more of a death benefit tune to it.
I'm just scrolling through our chat box and I'm not seeing any other questions. I would like to remind everyone that the full library of our brewcast can be found at www.e4.insurance, and that is including today's brewcast as well. Thank you so much for the excellent points, Dan and Brendan, and congratulations to Debbie. Thank you, Geoff, so much for sharing your time with us today and dispelling some of the myths and misconceptions surrounding whole life insurance. Please join us and tune in next Wednesday as we welcome Andrew Hara from North American as he discusses with us Retirement Plus, a strategy called Retirement Plus, and that is a way to supplement income while also providing protection within IUL. So thank you again, everyone, for joining. I wish you a great rest of the week, and we will see you next Wednesday on the Brewcast. Thank you.
Thanks, everyone.